I'd like to begin by thanking everybody for joining, those who are here live, those who are tuning in throughout the country. I'd like to give a special thank you to The Real Deal for hosting me in the studios today, and for Michael Weiss at Yale Street being the corporate sponsor. My name is Ira Zlotowicz. 18 years ago, I founded Eastern Union. Eastern Union is a commercial mortgage broker. We closed $12 billion worth of real estate transactions in the last 3 years. We're number 2 in the country in the number of transactions that we're working on. Over the last few years, a higher and higher percent of the business we are placing will be coins, bridge loans, hard money loans, short-term loans, construction loans. And I spent a lot of time analyzing why that's the case and the fundamentals and the metrics behind the scenes, how that's working. And that was really the impetus to be able to give over today the webinar to explain to people the benefits of bridge lending and how you could get involved as well. To avoid some confusion and clarity, there's 3 separate companies. There's Eastern Union, which is a mortgage broker. We bring borrowers to banks, we shop for them the best deal, negotiate on their behalf, and we close those loans. The second company is IRA Group. Recently formed the IRA Group. What the IRA Group does is that instead of brokering between a borrower and a bank, what the IRA Group does is that IRA Group introduces individuals that want to participate in these bridge loans. So for example, as I'll go into a little bit later, let's say somebody buys a $10 million deal. He goes to a bridge lender for 10 to 12% interest rates, and he borrows $7 million short term. That bridge lender goes around and has individuals participate in that loan. Those individuals that want to participate, IRA Group will act as a broker to introduce individual participants to participate with bridge lenders. The third company, who is the corporate sponsor today, and there's no affiliation, there's no ownership together in these companies, is called Yale Street. Yale Street is a crowdfunding platform. Yale Street will allow you to go from your home today and say, I want to get involved, and I want to participate in loans directly. And you could go onto their site, and you could, depending on accredited investor, non-accredited investor, and go through their site, they'll introduce you to different opportunities that you could participate in. The most important thing I'd like to start off with is really give a very important disclaimer and a disclosure. I'm not an attorney, I'm not an accountant, I'm not a financial planner. I'm not a rabbi, as we're going to get into a point here, is that there's a lot of laws that go in here. It's not real estate only. There's security laws that play a role in as well. And the securities law that play a role is how you can market a security, how you can market a loan, who you can take money from, and what disclosures you have to do. So the piece that I also want to add, and I mentioned not a rabbi, is that for those that are Jewish on either side of the equation, if you're lending, there's ISKA issues. So this is something you want to deal with your own rabbi, how you should deal with it. And the same way you can deal with on the legal side with the legal authority and accounting and the accounting side, I just want to put the disclaimers out there. Today is for discussion purposes only. I'm giving examples of a case that's very easy to understand, but there's no legal ramifications I'm taking. Let's start the presentation. What are the benefits of lending over buying? So the first benefit is that your first position. When you go ahead and make a loan, and God forbid there's a problem, and the building gets sold, you get your money back first. So as opposed to buying real estate, where you might be making a lot of money if things go great, if there's a little correction in the market, you lose the money first, the person who put equity in. So on lending, the first benefit is your first position. The second benefit, and this is what I found to be a pretty cool phenomenon, is that you could pick your level of risk. So let's say, for example, somebody's buying a building for $10 million. You think that that building over the next year will basically just be worth $10 million. If you were in charge of making a loan, you may only want to lend $7 or $8 million to have a cushion of some level. If you think that loan, that the buyer is going to, the building for $10 million, the value is going up, he's buying a great deal, it'll be worth $12 million or $14 million or $11 million, you may say, I'll lend a little more. I'll go up to $8 or $9 million as my buffer. If you think real estate's going to crash in that area or correct itself, you might only want to lend $6 million. In a normal case, people with a different view can't get together and make and go into a deal together. With real estate lending, you're able to set up a loan, which leads into the mixing of the A and B piece. You're able to set up a loan and say, you know, let the two of us come together. I picked my level of risk. I'm comfortable going up to $8 million. Someone else picked a level of risk going up to $7 million. The way they could do this loan is do one loan for $8 million, but break it down to an A piece. The person who's willing to only lend up to $7 million will take the first position A of this loan. And the person who's willing to go up to $8 million will write a check for $1 million. And now it's a 7 plus 1 for one loan of $8 million. If God forbid something goes wrong and there's $1 million loss, the B piece, the $1 million person took that loss. So obviously they're not going to share the profits the same with the loan, but they have the ability to pick the level of risk first and then mix and match the two levels when they want to go ahead and do a loan. What loan to value the lenders feel comfortable lending at? So obviously with all different underwriting and different levels and different homes and different marketplaces, the typical accepted way how a bank looks at loans is that for apartment buildings and homes, there are lenders that will go up to 80%. For regular commercial properties, they might only be willing to go up to 75%. And if there's some special situation, there's a storyline or maybe too many moving parts, they might only want to be at a 65% level. So just to give you a perspective, when we're going into here, banks that are regulated and they have to feel comfortable that they're not going to take a loss, they lend between 65 and 80% on almost 99% of all the loans. That's the height where they're willing to become comfortable. So what is a non-bank bridge lender? That's really what we're discussing here in the webinar today. So the first thing to understand is it's basically a group of people, just like me and you, that say, you know something? I'm willing to lend my own money on this property. And typically, they're going to lend in a case where a bank is not ready to move forward. So people think, oh, loans are terrible loans. They think about maybe sometimes merchant cash advance or the lending for security, or they're taking very high risk. It's not that it's high risk. Here's a building. Someone could call me up and say, Ira, you're a mortgage broker. Find me a bank for my building. I'm buying it for $10 million. The only problem is the building's vacant. So it could be no lender would want to lend while it's vacant. And if they would lend, they may only want to lend a very, very low leverage. It wouldn't make sense to the borrower. So instead of having to write a check of $10 million of equity, I would say, you know something? I would put together a group to lend you that money as a bridge loan. And I'm just stepping in because no bank, because of regulation, is able to lend you this quick. I'll lend you the money, you'll fix up the building, and then you'll be able to refinance it with a regular bank. The probably more common one is speed. A bank takes time to underwrite and to do their due diligence. It could take 30, 60, 90, 120 days to close a loan. Somebody doesn't have that time to wait. They could call up a bridge lender and say, can you close me fast? Well, I'll fix what I have to do, and then I'll start the process with a bank in a few months, and a bank will take me out when I'm stabilized at that point. The third point is that the bridge lenders take money from investors. They run around, they find people that want to invest with them. A bank takes depositors. We all have money in the bank. That's really what a bank is doing. A bank is taking all of our money, pooling it together, and making loans. And the reason why we're all willing to accept today 2% in the bank, or 1.5%, or 1, or checking accounts 0.05%, is because the government has FDIC insurance, which says you lend to the bank, you put your money in the bank, it's liquid, you can pull it out when you want, and if God forbid something happens, the government will cover with up to certain caps there per account. But that's why we're comfortable lending. A bridge lender, it's up to each person saying, instead of my money sitting in the bank and being liquid in FDIC, would I rather make a higher interest rate and have my collateral, instead of FDIC, be backed by a first position of a mortgage? So tying it in is also regulation. As individuals, we could decide, and a bridge lender could decide, you know something? I want to go ahead and I want to close on this transaction tomorrow. I'm comfortable lending the money tomorrow. I want to close in a week. I want this due diligence. Each lender could decide. I want to clarify while I'm talking is that when I say myself, I'm not a bridge lender today. I'm a broker, so was using examples. I'll go to clarify further as I'm getting comments in, is that the examples I'm talking, what does a bridge lender do and how does it work? I'll continue on that path going forward. How are bridge lenders different than conventional banks? So the first difference is pretty much what I mentioned. There's no regulation. They decide what they want to do. They lend on assets, which is as follows. When you look at a building in your neighborhood, an apartment building, an office building, a shopping center, the banks that are making loans while they're cash flowing. A bank likes to be in a loan where there's two ways to protect themselves. One, the value is there. The building is worth $10 million if you're buying it for $10 million. Number two, there's enough cash flow to make the monthly payments. Bridge lenders, they don't care about the cash flow. They're willing to what's called asset-based lending. They're willing to say, you're buying a building for $10 million. We believe it's worth $10 million. We're willing to lend you based on the $10 million, even though today it's vacant, because tomorrow it will go ahead and be worth money from there. So the last point is that they're prepared to own. And it's a very, very important piece of the puzzle, because sometimes you have people who get a negative connotation, used car salesmen. It doesn't mean people that sell used cars are bad people. There's a connotation that goes with it. There's a connotation that bridge lenders are lend to own. They're lending with the hope that they could own. That's not the case. People that are in business of lending, they're looking to lend money. lend money, get paid back, and move on. They're not looking to foreclose. They're not looking to own. However, they are prepared to own. When they make that decision if they should make a loan, they're prepared to own it. So many times when I had a client who was doing a deal and he had to close very quick and he just won a contract, close very quick, the times when we were creative to get him the best money for that deal was we asked him, who is the bidder right behind you? You just bid 9.5. You just won this bid at 10. Who bid 9.5? That means someone else is willing to buy this at 9.5. And I called that person up and said, listen, you lost the bid, but you're ready to lend 9.5. You probably didn't bid 10. You thought you overpaid. Granted. But how much money would you lend him as a first position? And usually that person would be very comfortable to potentially go even up to $8 million and say, I'll lend $8 million and close in a week because that person did their due diligence. So they're willing to own, but they're not lending to own. The terms of these loans are usually totally different. They may never go above 70% typically. A bridge lender that's doing loans will float between 65 and 70% typically. Often, their rates are between 9 and 12%. I want to bring up a point. Bridge loans were always at 12%. What you're seeing in the market, I'm going to explain a little bit later on, how come the same bridge lenders are lending now at 9 or 8 or 7? It's going to be because they leverage it up through banks to APs, I'll talk about. But today, the typical bridge loan, when someone has to close fast on a commercial property, is probably 9 to 12%. If there's some cash flow in it, there are different funds that want to win your future business will go and lower the rates as they're going through. Also, it's called a bridge. A bridge is basically, you have land here, you have land here, and you have a bridge to go over the water. A bridge loan is not a long-term loan. It's bridging you from today until you get taken out. So typically these loans are about a year, but they might go as long as 3 years to do these loans. And the fees are higher. The bridge lender, because of the risk they're taking and the time they're running around and putting everything together, will typically get a 2% fee. So if they're doing a $7 million loan, they're going to get a $140,000 fee in order to go put together that $7 million loan. Now, we spoke about all the great things. What are the risks of lending? So the risk is, what I said, the biggest pitch in the beginning is usually the biggest plus is usually the biggest negative. You're lending because you're first position, so you feel comfortable. But however, there's a few things that could jeopardize the first position. Number one is title issues. And that's why you want to make sure you're using a good title company that when you close your loan to make sure there's no previous liens on the property. Because if I lent $7 million thinking that, oh, $10 million building, I'll lend 7, and really there's a previous lien, that boots me out. The second thing is unpaid taxes. That's why so many lenders today want to escrow for taxes. They say, you make the monthly payments on the taxes, we the lender will pay the taxes, because if you don't pay the taxes, taxes take the first position. And the third thing is an environmental issue. You could do an environmental report, like I'll bring up soon. However, an environmental report, if an environmental issue comes up on the property, the city and the state can make you remedy it first, and that takes a precedent over the first mortgage. The second thing is change in market conditions, and this is really, really important. I mean, you know, I put at the bottom of the list rent regulation because it doesn't apply to everybody that's listening, but the truth is rent regulation is a very important point. You buy a building expecting that you're going to be able to turn over the rent at free market, and then the laws change on you. You have what we call the Amazon effect. The Amazon effect is changing how people shop and retail stores and how much they're growing. That's changed a big dynamic. The Uber, which just to put out two examples, is that buildings that were located right next to a train would be able to get a little bit higher rent because the person could wake up in the morning, they're right by the train. The further out, the rents weren't the same. With Uber, you have certain people could see the difference in price and say, you know something, I could walk, and on the day I don't want to walk, I use Uber, and a couple of extra dollars a day is still cheaper than the rent, and I get probably a better apartment at a cheaper rate. An interesting thing about Uber is that there's a city in New Jersey that had to change over the commuter parking. And the issue they're running into is the millions of dollars in cost. So what they did was they made a deal with Uber. And they told Uber, they made a deal with anyone who lives in the city and says, it would normally be $4 to park. They told somebody that if you would go ahead and take an Uber from your home to the parking, for the train, you just have to go ahead and pay the same $2 there, the same $2 home, and the city paid the difference. By doing this, they didn't have to redo the parking, didn't have a nightmare, didn't have an over budget, and have every day incremental cost. Whoever went from their home to the train and the train back, they paid every dollar above the $4 piece. And the last thing is WeWork. So forgetting about WeWork being all over the news, they became like the brand. You know, you take Kleenex, you take ketchup, you have WeWork. People say WeWork means how you deal with this office space. Look what's happening now in a marketplace. I have an office. I used to sign 10-year leases. I'm not sure that we need 20,000 square feet or 25,000 square feet. In the past, I'll take 25,000 for growth. With a WeWork, I might say, let me take 20,000 square feet. If I need the extra 5, for that period, I'll take a WeWork and I'll use a WeWork space. It changes the dynamic. And today, we talk about technology soon. Today, I could open up offices throughout the country without signing big leases, make a deal with a WeWork type of a company, and I let people work in the local market, no long-term leases, try things out, and once we settle in, then take a longer-term lease based on the size we need. The third issue, and this is really what I believe is the main risk. Everything else you could hedge for. But if there is a problem, it's the time and cost it takes to work it out. So when I did a lot of research on this topic, and I toured the country, and I spoke to people, lenders, and people that want to invest, and participants, this is really what the risk is. They're comfortable that if they're first position and they underwrote right, they'll get their money back. The issue is, how long would it take if there is a problem? It might drag on for a year, 2 years, or 3 years to fix the problem. The last item is possibility of fraud. Can you be defrauded? You could be defrauded. But ultimately, if you have a very good attorney and you have good title, at least you're in that first position, that if there is a problem, you get your money back first. So let's use a storyline to actually go through a deal. We can use an apartment building, $10 million purchase, vacant, partially vacant. The person buying it is going to be putting in $2 million on top of the purchase price of $10 million. They can buy it for $10 million plus $2 million in closing costs. And just for the purpose of names, I'm not that good with names. So from memory, I go Larry is the lender. I'll do Barry as the buyer. So now Barry's buying this building for $10 million. They'll call me up and say, Ira, please shop out this deal to the market. I'll take it out, of course, to try to get them the best rate, the best terms. From a bank, they'll be very competitive in today's market, 4, 5, 6% based on a building like this. Let's say when all is said and done, based on the speed, based on the storyline, based on the leverage, it works out better for the client to take a bridge loan. He figures out, call it cheap equity. And he says, maybe instead find me a bridge lender. We went out, the best bridge lender for this deal, and the speed and the timing and the details was Larry. Larry's ready to go and lend $7 million. Larry, at this point, prepares a letter of intent, sends it out to Barry, and he says, I'm lending you $7 million, 12%, and 2 points. Let's move forward. What does move forward mean? What is the process? The process is that Barry signs a letter of intent. Barry gives a deposit to Larry to cover all the expenses that Larry has as a lender, and then Barry sends the list of due diligence items. I want to now digress from the story, and this is, it's really the impetus for the whole webinar, aside from the pricing, how much money someone makes. Think about you want to go into real estate and buy real estate, and I want to show you, compare and contrast the difference. What are the benefits of syndicating loans versus syndicating buying? The first benefit, you don't have any money at risk before closing. Look at this story here. In this story here, Barry went out to try to buy a building. The minute he found the building, he had to hire an attorney for contracts. He found a bank, gave him a deposit. He has money he put up. On the other end of the table, what did Larry do? He put together a term sheet, and he told Barry, you want to move forward? Put up all the money to cover my costs to move forward. Number two, when you're lending, you have the luxury to be conservative. What's conservative? I could get a phone call today, which happens many times from new banks, new bridge lenders, and says, Ira, what's the market today on bridge loans? I could say 9 to 12%. This person says, I want the best bridge loans available. So the same deal, someone's paying 9 to 12, I'll put out money at 6. I say, you sure? He goes, yeah. I'd rather start with the best deal you have and learn it on that. So the ability to be conservative. Think about when you're buying real estate. A $10 million deal. How are you getting someone to sell you that $10 million deal? You aside from putting up money, you probably have to convince them, if you're starting out, sell me the $10 million deal, and there's no room to be conservative. You probably have to overpay or give an extra double commission to somebody to be able to win that bid. Another part, you don't need any money in the deal. When someone is syndicating a loan, a bridge lender, they could actually go out there in all cases, probably put together the full $7 million without having to have any of their own money in. When someone's going to raise money for a deal, since it's the riskiest part, the purchase, the equity, most people giving money to a deal will tell the GP, the person, the syndicator, putting the deal together, how much money do you have? Maybe only a small amount, but you have to have what they call skin in the game. The next point is deals chase you. There's no seller chasing buyers, and that's not what's happening. But when it comes to lending, when someone has when there's a bank out there that's very competitive, and they're known that they could close, you have people soliciting the bank, hey, I have this deal, are you willing to lend me money? So the ability to go the other way around. The last point is you can learn the business from the borrower. If you're trying to buy real estate, who's teaching it to you? I want to tell you a great story, which I really think puts this point out on bridge lending and about the education part at the same time. So there's a fellow that builds office buildings, and he's building a lot of smaller deals under $10 million. He's finally putting together his first big deal. It's a $40 million construction loan. He wanted a $40 million project. So he came to get quotes and get banks to finance the deal. He said he has great experience, great track record. He could build it in 12 months. So he went out to the market, shopped it out, $40 million deal, started getting offers at $30 million. He got 75%. He had a good track record. Everything looks fine on the surface. As the bank started doing due diligence, the bank says, you'll put up the first $10 million. We'll give you the last 30. The problem was that as the bank did the due diligence, the bank said, hey, you price in how much per square foot? We think it's going to cost you more to do it. You think it'll take you 12 months to build this? No way. It'll take you 2 years to build it. And by the time he was done, the projected budget was $60 million, what the bank believed it would actually cost. And the bank said, I'll still be there for 75%, but 75% of 60. So you, on a construction loan, put in the first $15 million. Okay, I'm not putting in $15 million. The deal's going to cost me 40. And as it is, your bank ain't going to go slow. He went and opted and said he took a bridge lender who was willing to close for him right away, which gave him the benefit that he could finish quicker, start collecting rents quicker, offset some of the money that way. But more importantly, the bridge lender told him, you only need $10 million. So he only had to take $10 million worth of equity from his partners. Ultimately, one of the lines, as he was building and how he's getting everything working throughout the process, was interesting, is that they asked him, how did you build it so fast? Is there a law you can't work after a certain time at night? He said, yes, but I went out there, and I'm not condoning this approach. I was telling you the facts of his story. He says, what I did is that I built 24 hours a day, and I got a fine every day. The fine's $1,000. I budgeted in my budget $365,000 as part of my budget. So instead of just working until those business hours and take a 2-year project, I did it done in a year. And I got a loan by only needing to spend $40 million in total. And I got it done in a year, and I moved forward from that point. Going back to the storyline, what are the main due diligence items that Larry needs? So it's like they say in the Army, it's trust and verify. Obviously, Barry came to the table, he made his presentation, and Larry gave him a term sheet. But still, Larry wants to do the due diligence. This is similar as a bank does it, but again, without regulation. It's up to Larry to what level he's going to go into detail on the trust and verify. So REO is real estate owned. Personal financial statements, get tax returns, get a flavor. Who is this borrower that's coming to the table? Number 2, get a copy of the current income and expenses and the projected. When this project is done, what is it going to look like? And then what leases do you have in place? What comps do you have? And a lender would actually pick up the phone. Appraiser will do this also, but the lender himself, aside from knowing the market, would probably pick up the phone to a couple of apartment building owners near it, or if it's retail, check how much vacant space is going for, and actually see, what is a 2-bedroom renting for? What is a 1-bedroom? Someone told me a great story once on due diligence that they want to see what's really the occupancy in a certain area. And someone's saying, oh, this building, we only have very, very, very little occupancy, it's for sale. He had someone call up the building and say, I have a business, I'm looking to relocate a lot of staff, but we want our staff to be in one building. Do you have like 15 apartments in one building, in your building available? It's a huge complex. Oh, 15? By the way, we can really accommodate you. We have 30 or 40 if you need. Now he knew what the story was from going on as far as the due diligence level from there. So the third part of it, going back, is ordering third-party reports. What are those third-party reports? Is the appraisal? It's going to show value. And I want to say a very, very important thing is seeing all the conflicts that are going around the appraisal. Appraisal is an opinion. It's not a fact. People say, well, the appraiser said. It's just an opinion. It's one man's opinion using comparable data that say what closed recently in the area. Like I say over the story, there was a brokerage firm in New York City, a very prominent brokerage firm, that they used to say, we guarantee to sell your building at the highest price. And that's the owner said, how do you guarantee selling at the highest price? I mean, he goes, you sold the building for $3 million, maybe it's really worth $3 million too, and you undersold. He says the only time that something is actually the real value is the minute it closes. So if we close today at 12:03 for $3 million, and there's no one in the room sticking out the hand for $3 million too, ready to close this second, then that shows that is the value. Everything else is an opinion. Because something closed at 12:03 at $3 million, last week a building closed at this price, they come with an opinion for the value. Environmental reports. Like I said before, you can lose first position, so they want to see what's wrong with the building. On an environmental report, is there any environmental issues on the building? Engineering reports. Is there any structural issues with the building? When will the roof have to be redone? So they know if they should reserve money for it or negotiate with the seller to take down the price. Or if you're making a $7 million loan, do you want to say, hey, you have to do the roof in 6 months. It's going to cost you $500,000, $250,000, $100,000. I'll lend you $7 million, but I'm holding back that money to make sure you do the roof. And then, of course, the title and survey, making sure that you are first position. So how does Larry put together the $7 million? We're discussing a $7 million loan. So he's either doing it himself, his own money. More commonly, He syndicates it. He runs around, takes money. We'll show you a slide soon. Takes $1 million here, $500,000 here, $2 million here, puts it all together. He has a $7 million. Or he syndicates the A, B piece, which he'll break it up. He'll go to a bank for the first part of the loan. He'll go, and he'll only have to take friends and family for the top piece of the loan. So in either which way he wants to do it, there's no rhyme or reason. So let's give a little bit over here Larry's universe of potential participants. So this is really an illustration, and I think it's very important. We go up a little bit on tangents about the law, and this is where it's very crucial for those of you that raise equity, those of you that broker equity, those of you that broker debt, those of you that lend. Larry's here in the center. Just for color coordinated purposes, you have on the screen the blue. Let's say those are people Larry knows direct, previous investors, friends and family. Over the years, people say, Larry, do deals. Can I put money in with you? He built up a database. So when he has this loan, he sends out an email of some sort where he calls his universe and says, hey, I'm doing this opportunity. Do you want to participate? In a case where he is lending out at 12%, and that's what the barrier is paying him, he'd probably pay his investors 10, and he'll keep the difference. So he'll pay his investor group, his participants 10%. He'll lend it out at 12, and he'll keep that difference between the 10 and the 12%. He may also call up the IRA group and say, IRA, do you have any people in your network that would want to participate? He'll call, he has a friend, John, who's been introducing him to people. He has a friend, Isaac, who's introducing him to people. That's the group. But I want to explain why I put the X on one of the people. The reason I put the X on one of the people is as follows. Is when you're making a loan, or you're raising money, whether it be for a loan, whether it be for a deal, there are securities laws, not real estate. Don't say my real estate attorney said it's fine. These laws govern from who you can take money, what disclosures you have to do, and who you could pay. You know, Eastern Union we say we do debt and equity. We don't do debt and equity. We're a mortgage broker, and then we have a sister company that's licensed. And I'm not licensed to broker equity. My partner is. I have a great staff that is. But they broker equity, they're licensed. And the rules are very, very stringent about who they could take money from and who you could pay. So when you're doing it, when you're going to go raise money, you have to make sure that is this structured as a loan, and then what restrictions are there? Is it structured as a security? And then what restrictions are there? So it's possible that I could have someone that for a certain type of structure, I could bring them in, and for a certain structure, I can't. For a certain structure, I could earn a commission, and for a certain structure, I can't earn a commission. And I'm not telling you what it is and what the case is here, but this is where you've got to get yourself a very good securities attorney if you're in the business of brokering equity, raising money, and participation. Who did Larry actually take as participants and why? So if you look at the wheel here, he raised $7 million and he paid out 10%. And the numbers are all over the map. And that's exactly the answer. The answer is he took from, there is no rhyme or reason. He took from whom he wanted to and why. It could be he took from someone smaller because it's a friend of his and he says, I'll do you a favor, I'll let you put some money in. It could have been because he owes this guy a favor. It could have been because he wants this person to start with him on this deal, and in the future he'll do more. There's no rhyme, there's no reason. And that's the key. People think there's a method how people raise money. It's all about a preference. Some people prefer to take money from less people, bigger checks. Other people, bigger checks from less people. It's a matter of a preference. Now I want to talk about how the technology, laws, and data change crowdfunding as we know it. So instead of the word even crowdfunding, it's changed the way people could raise money. And I think this is really a very big key, because just like we had the Amazon effect and the Uber effect, let me tell you how the effect is coming into our space as well. So number one is technology. I know myself. For the last few years, I did not have a computer on my desk. I'm running my company. All I have is my iPhone. And because of the Eastern Union app and because of the technology, I'm able to be anywhere in the world and access what I need from my phone. Obviously, even those that are sitting in the office and using a computer, but they're able to accomplish a lot more than they were able to accomplish in the past. You could have you have DocuSign, you could have all different technologies and emails, and instead of sending someone 400 pages and printing out the book, send one email, a PDF, and download it. You could sign online. So technology allowed people to do more and broader network. You could do research. You have people buying buildings today based in New York, buying buildings in Texas, and vice versa. You have the same amount of knowledge going on there. Why? Because part of it is the technology. This other part with the law is as follows. The Jobs Act of 2012 changed a major, major thing. And what changed is that before 2012, you couldn't advertise that you want to go ahead and raise money. If you noticed, we're here on the Real Deal presentation. Did you ever see an ad on the Real Deal? I'm buying a building. You want to participate? You never saw an ad like that. In no real estate publication. Shouldn't that be in every publication? The reason is because once you advertise something, you have security and you advertise it, a different set of laws kick in. But before 2012, you didn't even have the option to advertise. If you went to a hedge fund's website, it was just a note. You're interested? Call us. They couldn't even tell you what they're doing. And the government wants to protect people, the government has what they call accredited investors. They decide that someone that's making a certain amount of money is called sophisticated. And if they're sophisticated, they could go out there and they could participate in investments. My own 2 cents, with all that's going on in the world today, I'm really surprised that someone who's working very hard and they're not making that threshold, I'm surprised that they're not really fighting and saying, hey, I'm stupid because all I make is $50,000 a year. I can't invest my money, and only the rich could get richer. So I actually think, personally, over the next couple of years, the laws will change and allow a broader market. That's my own 2 cents. But for the law itself to change said, if you want to advertise as security, you can. But in the past, you were able to ask someone, are you an accredited investor? And you didn't have to verify it. Today, they say if you want to advertise, then you have to verify your accredited investors. So now you have technology and you have the law. The third thing that came together and keeps coming together is the data. If I wanted to go out and raise money, I had to find a rich person. How do I meet him? How to send them, print out a book and sign it. So even if I could get to more people, but the costs involved are very expensive. Today with data and target marketing, I could really be able to narrow down and zoom in exactly who I want to target. And because of all these 3 things coming together, it doesn't really make a difference if I take someone's money for $5,000, $100,000, or $5 million. It's the same process. And that's why on the buying of real estate and due diligence of real estate, that's what we're seeing. When you have these companies today, they're selling data, you have people buying all over the world. Why? Because they have the technology and they have the data that can give them that same type of information. How does Larry protect himself and the participants? So one, he hires a competent real estate attorney to make sure the docs are enforceable. That if there's a problem, they could start the foreclosure process. Number 2, review the title and survey to make sure that they're in first position. The other person you have to hire is a competent securities attorney. And a security attorney, the dream, if you're a bridge lender, your dream is that you could structure your investment as a loan. If you could structure it that you're lending the money, therefore it's not a security. Again, there's a way to do it. I'm not a securities lawyer, but that's something your dream is, because then you have a lot more leeway, who you could pay commissions to, how you could do things. But if you can't structure it that way, at least make sure that you're following all the proper securities laws when you go ahead and raise money. What are the final steps to get to the closing table? 1 is that the loan participants sign the participation agreement. They send the money over to the attorney or the title company in their escrow account. Number 2, Larry and Barry sign all the documents. And then you have congratulations, you have the closing. I just want to say a couple of things. Say really one joke. That when I came into the business, someone told me this joke, and they said, you want to know about real estate? Let me tell you about real estate. You're coming into real estate. They said, this person is in real estate his whole life. He dies, he comes to heaven. St. Peter says, you were great your whole life. You're going to go to heaven. You take the express elevator up to the penthouse suite. Gets into the elevator, the door opens up. He gets a little depressed. He's looking around. It's a real estate closing. It's a mahogany table, leather chairs. I'm sorry, he's excited. It's a real estate closing. It's a mahogany table, leather chairs, everyone's smoking cigars. He goes, this is unbelievable. My whole life in real estate, heaven is a real estate closing. As the elevator door is about to close, he turns around and says, let me see what the alternative looks like. Gets back into the elevator, goes down to the dungeon, the door opens up. Here he gets a little depressed. He goes, so it's a real estate closing. He says, it's a rickety table, metal chairs, smoking cigarettes. He says, with this difference, I gave up all those temptations in life. Turns to him and says, in heaven, the deal closes. So as a real estate broker, doing mortgages, I know the key is you got to get to that closing table. What happens post-closing? What does Larry do post-closing? So the first thing Larry has to do is he services the loan. He deals with all the back and forth that's supposed to happen from that point until the loan is paid off. And number 2, if there is a problem, he's the person that deals with that problem. And that's where that headache is running that problem. And you could say that's why he gets paid a lot of money. That's why he doesn't get paid a lot of money. Irrelevant. That's the person who oversees it. Now we spoke the history. Why are people doing it? How much money are they making? How much money did Larry make by syndicating the $7 million loan? And to put in perspective, the average loan in America today is probably between $8 and $10 million. That's it. If you take out the largest few loans in the country, it's probably down into the $5-6 million range. And if you take out, some of these loans, that means a $7 million is a pretty average loan. It's not like this big loan. He made $280,000 doing this loan. He made 2 points as a fee, the $140,000. He made 2 points in the spread. He paid his investors 10%. He lent out at 12. He kept his difference on a 1-year loan. That's that 4 points. He spoke in the advertisements about a 77% ROI, return on investment. How did he do that? And I want us to point out a very important point about lending versus buying. Okay, it's ordinary income. You're not getting the tax benefits. So many people do lending, by the way. They're doing the lending. If you want to compare apple to apple, it's not the same because of taxes. But to apples is that when someone has, one is short-term, 6-month, 12-month, 18-month loan, one is a long-term, you're making an investment. But how do you get to 77% ROI? If Larry would put $500,000 into this deal and do an A-B structure, he will turn his money on his $500,000 and 77%. Let me walk through with you. Larry lends $500,000 of his own money. Larry goes to a bank, $5 million of the 7, and we'll call it an A loan. He'll pay the bank 7% interest rates and 1 point to the bank. So he's into 7 and 1. On the Eastern Union app, there's a calculator to calculate if you're the lender, how much money you make, and if you're someone borrowing money and you take a first position, a second position, how much your blended rate works out. So 7 and 1. Then Larry goes and he takes $1.5 million from those participants. So, but here's the storyline that changes. When Larry first went out to his participants, he said, listen, I'm doing a $7 million loan on a $10 million building. Larry's a great borrower. I have a 30% cushion. Plus, he's putting another $2 million into the building. In the future, it's going to be worth $1.3 million, $13 million, $14 million. I'm only want to lend now $7 million. They all were willing to lend their money at 10%. However, now he comes back and says a little bit different. It's the same risk, $7 million. However, I promised the bank that they get the money back first. So our $2 million, my $500,000, and your combined $1.5 million will be in the first loss position. Which means if there's a problem on this loan, we're the B. If there's a problem and we lose $500,000, each of us lost 25% of our money. So it's not like we shared over $7 million, we shared over $2 million. So even though the risk is the same on one end of it, but if there's a loss, they're sharing a bigger piece of the loss. So instead, they say, listen, if that's the case, we're willing to come in, but we're not just taking 10%. You want 12. Don't make a profit off me. You're getting a 12, that's what the borrower is paying you, it's paying you 12, we want the 12. You're making 2 points, give us one of the points. But as you look through the numbers, he's still better off on this transaction. So for Larry, still does the deal. Larry lends $7 million, 12% interest rate, and 2 points. There's $980,000 collected in 1 year on points and interest. $400,000 goes back to the bank for their point and their 7% rate. Then the loan participants get $195,000. There's $385,000 left. So I'm $385,000 against the 77% ROI. So when you have Larry doing a deal like this, he's in a better situation. Everyone's happier, doing a loan, and he probably has more money to keep scaling himself up. What are the pros and cons of splitting an A loan into A and B? Splitting a loan into A, B pieces. So the pro is unlimited A-piece money. There is so much money out there because banks today have to be conservative. They can't go on this building lend $7 million, but $5 million, they could get comfortable, especially with double layer protection. They have a buyer who bought the building thinking it's worth 10 and put a few $1 million in. They have a bridge lender who they trust to have a relationship with that doesn't have really any losses on their other portfolio. They say, hey, this person underwrote a loan at $7 million. And in order for us, the bank, to take a loss, those two have to be out and wiped out of the business. So banks are willing to lend. Like someone said, so why doesn't the Barrett go straight to the bank? He could go straight to the bank potentially, but don't forget, the bank's only there for $5 million. He needs $7 or $8 million. The bank can't close in a week. Larry could close in a week or 2 weeks. Sometimes Larry could close for $7 million and then get the bank to take him out and refinance it, so to speak. And now he has an A piece from the bank after closing. But more importantly, sometimes the bank doesn't want to deal with the borrower. The bank is comfortable because it's structured legally term is, it's like a note-on-note financing. There's a structure that it gets the bank comfortable that they have security of a note and they have a security of the building at the same time. Here's the con for Larry. When Larry takes a loan, he controls the whole process. If they have to give an extension, he gives an extension. If there's a problem, he works it through. But if there's a bank that's following him, he can run into a problem. What happens if he does a 1-year loan? At the end of the first year, there's a problem. Barry needs more time. The real estate market's getting a little shaky. And he wants an extension. The problem is that Larry turns to the bank and says, the bank, could we extend for 6 months? And for whatever reason, the bank says no. Right now, there's a problem. Either Larry has to pay off the bank, or the loan will be in default because the bank didn't give an extension, and the bank will start accruing at a default rate. And that means he's not going to owe the bank this $5 million, but he could start owing the bank a lot more money, and even worse, the bank has the right to foreclose on him. For a bank to foreclose on the B notes is a very quick process. Definitely quick compared to on a real estate. So very quickly, the B note can be wiped out, and now you have the bank in the first position, controlling a $7 million note, and has the power to sell it at a $5 million price and still be walking away and be made whole. In my humble opinion, the safest money that someone could do with their money is to participate in the APs. That's the belief. When I did research and I spoke to tons of banks, and I asked them, in the worst day of the crash in 2007 and 8, and tell me on a deal, now exclude land, excluding homes, when you saw a loss, what losses did you see? When someone bought a building, and the number they said is if you would ever lend 40%, a 40% cushion, meaning you lend only 60% loan to value, if you do the right due diligence, you're not going to take a loss at the end of the day. Can it drag? It could drag. And again, no legal disclaimer here. So when I'm getting involved in watching this, I was able to broker, be very successful in brokering those that want the bridge loans to BPs, and they syndicate amongst themselves and find them APs. And even I'm thinking about putting together an 8 fund to actually go out there and say, you know something? There are private people who have money that want to participate in the safest piece of it. But overall, someone doing a bridge loan starts, and then making on the bridge loan, they can make 2 points and a 2-point spread. If they leverage it up, they can make a higher return on their money from going forward. How can I get involved in this space? So I broke it down into 3 different categories. You could jump in, syndicate your own bridge loans. You think you have family money, family business, knows real estate, jump in. Find your own participants. Have the IRA group help you with more participants. Have Eastern Union fund your deal flow. Become another lender. Number 2, take it slow. Become a broker at the IRA group and just feel your way around. See if you go to your friends and family if they would want to participate in loans. And then if they do participate, and it's a deal that you're able to earn a commission on because it's a loan participation versus security, earn a commission there. Number 3, participate in a bridge loan. You have money, watch the process. Find a bridge lender, use the IRA group, someone that you know, and say, let me watch the process. Or you go to Yield Street. Go now onto Yield Street now, onto their website, yieldstreet.com, and watch loans that they're putting in, and go in if you want to be, if you want to participate in the loans that they're putting out. I want to thank all of you for joining, and I want to thank again Yield Street and The Real Deal. The webinar is ending now. I know there's ability to ask questions via typing in the questions. If those want to ask questions, I'll try to read through the questions and answer. And I want to thank everyone for joining, and I hope this was informative and beneficial to you. You have my contact information at any time to reach me. I look forward to helping you. So can you get a bridge loan for a development site? The answer is yes. There's bridge loans for everything. There's bridge loans for land. There's bridge loans for any real estate under the sun. There's bridge loans for everything. Personally, I only put bridge loans for, I only get involved in bridge loans backed by real estate. That's what, as Eastern Union, that's what we do, but there's bridge loans for everything. So what's the minimum requirements for someone to invest? So that's where Yield Street, they are a crowdfunding platform. I believe that number is 5,000. We'll take a minimum of 5,000 above. Otherwise, there's no minimum. Afterwards, it's about finding like another Yield Street, finding a lender and saying, you put out loans, how much can I participate? Just realize there's a whole industry called fix and flips, which someone could buy a home out of foreclosure for $100,000, $200,000, $300,000. They fix it up and they flip it out. In those loans, the whole loan is only $100,000, $200,000, $300,000, sometimes less. So depending where you want to start, that's the way to break in. I apologize for someone saying that the audio is going in and out. Okay. So I want to thank everybody. We're going to end it here. Thank you very, very much, and hope this was a help and a success for all of you in all your endeavors. Thank you.